Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and today we have one of my very, very favorite people to interview that has so much knowledge. And Grant, I always tell Grant he is the Johnny Carson of financial interviewing because I really think he is, by the way. I just finished one of maybe the best interview I ever saw with Neil Howe with Grant. He just does such a great job. But Grant, welcome.
Ted, thank you for having me. It's great to see you again. You're
Yeah.
looking very smart.
Well, be careful about the looks. But anyway, what I was going to say is one of the things we love about you too is that you not only write and interview and do all those things, but you're also in the money management business. You're an advisor to two different groups, so you know what goes on day to day, and I really think that makes a difference. But what I want to get into off kind of from the top today is we have a slide that you're seeing that is basically shows inflation volatility
Yeah.
from 1965 until now. Here's my question to you, Grant. If you look at the left side of that 65 to 90, do you think we're headed back into something like that?
Well, look, I think it's funny if you take a step back from that chart and go back a long way, you'll see that declining inflation is really the trend. There are just these episodes where inflation picks up, things get out of control, and volatility picks up. So I suspect we are heading back to something like that, if not already in it. It will come, it will happen, and it will pass, and we will get back to the kind of declining interest rates because that's how the entire financial system works. But yes, I think when I look at that chart, what stands out to me is this period we've had encompassing on the chart there from 91, I guess, through to 2021. So that's 30 years of really benign inflation volatility. And that green shaded area is basically the length of just about everybody's career who's in the markets today. So I think the important takeaway from me from that chart is whatever we're heading into, it looks unlike anything that anyone who's most people who are trading in financial markets today are familiar with. And that's really the problem. It's a very unfamiliar and potentially very dangerous market environment.
Well, that's what I think. My career spans the left side in the middle.
Right.
So
Right.
I had a piece of all of that stuff. I was a young guy, very young, by the way. Okay. But anyway, it's an interesting thing. The other thing you'll see here is, I think people have quit believing in the yield curve inversion leading recessions. I think they've sort of thrown it out the window, and you'll see that graph. But do you think that that's a useless indicator now, or is it still indicating we have some trouble ahead?
Look, if it's funny, if you look at that chart, you can absolutely understand why people have decided to discount it. You can absolutely understand that because we've gone uh, to sort of levels we haven't seen since the mid 70s in terms of the inversion, and nothing's happened. So because nothing's happened yet, people are very happy to say, well, that doesn't work anymore. And I just don't think that's true. I think it's a great precursor. I think it's a great signal. I just think there has been so much thrown at markets in the kind of intervening years between those previous recessions and today that they've kind of altered the transmission mechanism of markets. And so, whilst this is a great sign, and we all know what it means, is very much leaning towards a recession. The fact that it hasn't happened yet, I can think of all kinds of mitigating circumstances in terms of this excess liquidity that's sloshing around markets, in terms of fiscal and monetary stimulus. There are all kinds of reasons for me why maybe it hasn't happened yet, but to write it off, I think is incredibly foolish. If you can go much further back on that chart and you'll see a similar sort of thing, you'll see recessions happening after this. So no, I don't think it's a useless indicator, although I do understand why people are willing to write it off at the moment.
So if you look, you're going to see a couple of slides go up, and this has to do with banks and mortgage rates. But the banks, obviously, you'll see how they're obviously credit's gone negative for them, and then the 30-year mortgage rate just hit 8, the last week or
8%,
so. Do you think that there's still more pain to come with that just hasn't gotten into the marketplace as far as real estate, the banks, et cetera?
yeah. Look, I think there's always a lag. Right? There's always a lag. And just because the mortgage rate's at 8%, we're starting to see that feed through in terms of number of home sales that are declining. We're starting to see it come through in housing starts declining. we're starting to see the kind of knock-on effects of having more expensive money. The beauty of America is you have one of those deep mortgage markets where people can fix their mortgage rates for 30 years. And so a lot of people have done that, thankfully. If they hadn't, if we were back in the sort of early 2000s where everything was kind of arms, as per Mr. Greenspan's recommendation, we'd be in a world of trouble. But there is a lot of fixed out there. So I think that helps explain the lag. But what you're going to find are people who want to get in the housing market now. Look, if the mortgage rate has tripled in the last 18 months, it means the house prices, in order for the affordable payments every month to be the same, house prices have to fall 66%. It's pretty straightforward. We just haven't seen that yet. And I think we're in that kind of air pocket where the sellers are still trying to sell. The buyers literally can't afford to pay these prices. And when mortgage rates were in the, you could fix for 2 and change for 30 years, people would borrow that little bit extra because they wanted to get the house. And so a lot of stuff was trading on the offer. That just doesn't work anymore, because at 8% to borrow that extra little bit to cross the spread, it's very, very expensive. So I think this is a very much a leading indicator, and we're yet to see what it means to the housing market.
And, Grant, you've lived and worked in numerous countries, Europe, seeing different places in the Far East, Australia, but a number of those countries have a lot of floating real estate debt.
Yeah.
Am I right on that?
Yeah, that's exactly right. It's very unusual to have a 30-year fix in most of those countries. The UK, certainly Australia, you can fix for 2 or 3 years. So all that activity we saw during COVID, where people were running out and buying houses and, of course, paying up to get them. We saw what happened to house prices during COVID because money was cheap. All of those are going to start to come off this year and into next year. So we are going to see, unless rates come down between now and then, which they might in the short term, we're going to see a lot of pain rippling through housing markets right around the world.
Well, this question I have for you is sort of an unanswerable question, I think. But if you'll see this slide on the U.S. national debt at $33.5 trillion.
Yeah.
And I know you being around a couple of investment companies you work for and do work with and advise. When somebody asks you, well, what's going to happen here? Because I get this question all the time. I can't answer it really, but I'm curious as what your answer would be.
Well, look, nothing good is the answer, right? Nothing good comes of $33.5 trillion of debt, and I think we're starting to see this matter. I've been saying for many, many years, we've lived in this weird environment where nothing matters to anybody until it matters to everybody. And I think the debt is probably the single most glaring example of that. We've watched the speed with which it's gone from 20 trillion to 25 to 30 to 33. And the pace at which the debt is increasing now is staggering to me. And given the outlook down the road for the budget balance, which is going to be deeply negative for years to come, the predictions from the Central Budget, Congressional Budget Office for this debt, the trajectory it's on, are unsustainable. And suddenly, I think you're starting to see a lot of that play out in the rates market. You're starting to see people say, hey, either in the case of China, for example, who are selling a lot of their treasuries, you're starting to see people either say, look, we're going to want higher rates in order to fund this debt, or you're going to see the US having to sort of print and cover a lot of their debt, or you're going to see some kind of yield curve control. Either way, it doesn't bode well. And this debt is going to matter, I think, a great deal suddenly to an awful lot of people. And when that happens, look, you know as well as I do, $33.6 trillion of debt on a 20-something trillion dollar GDP, it just doesn't end well. It never has, unless you can kind of inflate that debt away. So I think either way you look at it, inflation is going to be the problem we have to mitigate going forward. And it's not a problem we've had to face for some considerable period of time. So people just aren't kind of ready for it.
Well, it certainly seems like it spells slow growth anyway, when you've got that much debt. And speaking of debt, I have a piece here about private equity, about how obviously there's selling less pieces out of private equity, the number of deals down, a lot of things, obviously a very leveraged group of people. And one of the things I love about your service, by the way, is in addition to your interviews and your podcast, and when you write on things that go, and you did a piece on this some time back on private equity. Excellent piece, by the way.
Thank you.
They haven't shown up yet with any trouble, but it has to happen to them at some point. Wouldn't you think that?
Yeah, look, I think those exit values, the fact they've halved, is not because they've decided they don't want to make any more exits. That's the important thing to understand. They would make as many exits as they could if the market was there for them. It's not. So you're seeing a declining number of exits happening here, obviously. And look, there are ways that, because it's the nature of private equity, there are ways they can disguise the problems, but they only last so long. We've seen an awful lot of instances of private equity companies raising new funds to buy assets from themselves to make their returns look decent. So this is the problem here: is they're at the tip of the iceberg here, and the longer they are unable to do what they need to do, and they don't have the flexibility to reconstitute their holdings, get the exits out the door, the more desperate they're going to get, and the more problematic it's going to be. We've seen assets trading hands in the secondary market at vastly reduced valuations. We saw CalPERS dump a load of private equity assets for a sort of 25% discount to the last mark. And I think that's what's going to happen. If mark to market is forced in any of these for any reason, it's going to start to get very ugly very quickly. And so I'm paying really close attention to kind of headlines around private equity.
And Grant, I don't know what the percentage is, but there's a certain percentage of high yield debt that normally would have been in the public market that's in the private equity market, a private side debt now. At some point, you would think, I'm asking you a question here, that some of that has to have some trouble somewhere in here.
Yeah, I think the problem, Ted, is everywhere you look there is trouble. And this is I think the big problem. It's very difficult now to see a smooth path forward for any of these assets. And I think that the advantage we've had in the last kind of certainly 15 years of QE is there's been this kind of path for stocks to go higher and bonds to go higher. We've kind of seen that. So everywhere there was trouble, you could always say, yeah, but there's trouble in junk bonds. Yes, but investment grade looks good. Stocks look good. Right now, it's difficult to find that one place in the market where you can say yes, but. And so everywhere you look, we're having the same kind of conversations. Look at junk bonds, look at the debt, look at inflation, look at the bond market, look at the fragility of the equity market, look how narrow it's become. And all of these problems are manifest now because people don't have anywhere to point to and say yes, but. So it's kind of difficult to find bright spots. And I think that's kind of weighing heavily on the sentiment of market participants.
Well, and speaking about the debt, there's a slide here that shows just what's happened to 30-year Treasury, since July. Yeah. My question to you would be this: do you think that really caught people off surprise, this last move in the long bond on the rate side?
It feels like it has. I mean, to be honest, it shouldn't have. But I think what's caught people by surprise is not necessarily the move in rates, but the tenacity with which the Federal Reserve are pursuing what they stated they were going to do. They said they were going to raise rates. They said they were going to get inflation under control, and nobody believed them. And so I think that Treasury market right there is really an example of just how offside people have been caught by the Fed rather than the markets. The markets are playing catch up to the Fed's reality now, and that's what's being reflected, I think, in a lot of these bond market prices.
Well, and my next slide really looks at the 20-year Treasury bond, and interesting enough, that your last things that go, do you wrote, which was great, by the way, is all those pages about this topic, okay, about the drawdown. And you have some super slides in there. But as you said in your topic, on the drawdown on the 20-year, the tilt was like 50%, from the high. And then I listed on the left-hand side, the tilt is all the way back to where it was issued in 2002. And so are you wondering why, if you look at the next slide, are you wondering why we keep having the public in the red line you'll see on that slide buy into that? It seems like they just keep buying into it.
Yeah, look, and again, I think that the TLT has been, it's that easy vehicle to buy a slightly more complicated asset, and everyone's wanted to own bonds, and a lot of people have owned it through the TLT. The ETFs have been great in giving people liquidity and access to investment classes that are just slightly more complicated than that. And the Treasury bond, even though you can own them direct through treasury.gov, it's not that difficult, but it feels more complex to people. So the ETFs have seen a lot of herding of people piling into them. And I think that second chart with the red line there, the cumulative flows going up as they've gone down, that just harks back to this unwillingness to believe that the Fed were going to stay the course. That's the people saying, well, we'll take the other side of this because they're going to cut, they're going to cut, they're going to cut. I just don't believe that they're going to be able to get rates up here, and it's going to be a problem. When we get a capitulation in that, I think you'll see a big flow out of that. And that's probably about the time when you want to start buying again. But until we see that capitulation, a lot of that money there, and you can see just how extraordinary that rise in the last couple of years has been. Until we get a capitulation, then we start seeing serious flows out of that. I just think it's catching falling knives. I was talking to my friend Peter Atwater this morning, and he said he's never seen so many people trying to catch knives, and they are right now in exactly this, the TLT.
It's interesting because I see that all the way around. And I wanted to ask you this too. One of the things about it is that if you look at the industry group, the people who have only been around the last 15 years, they're really locked into this 60-40 mode. They can't get out of it. And you're like, and we transfer in portfolios, things like that. They all look alike because they all have the standard 60-40, but they don't make any changes.
Yeah, I mean, look, we've all herded into the same trades. Of course we have. It's just because we've had this environment that has kind of rewarded you for going with the flow. It hasn't required a great deal of careful structuring or kind of out-the-box thinking. Everyone's ended up in the same trades, and that's why you kind of see these big swings. And that 60-40 is problematic with what's happening. The mark-to-market losses on these bond portfolios, the unrealized bond losses that took down Silicon Valley Bank and Signature Bank back in March. People have forgotten about those, but there are a whole world of people out. Bank of America announced this week, I think, $131 billion of losses marked to market in their held to maturity bond portfolio. That's potentially a massive, massive problem if there's any kind of loss of confidence in the banking system, and we see depositors wanting to get some of their money back and move banks. It's a huge problem. So I think, look, the overarching thing here is that we're in a very different world now, whether it's in equities, whether it's in debt, whether it's in rates, inflation, whatever it may be, even with central bank action. And the markets haven't fully adjusted to that yet. They've adjusted in price in some cases, but the behavior hasn't adjusted yet. And that's the kind of last shoe to drop, is when people change their behavior. So we've kind of still got that unfortunate little episode still to come, I suspect.
And speaking about that too, which is same group of people in this last 20 years, but, we haven't seen a commodity cycle in a long time. And
No.
So do you think we could see a stronger commodity cycle the next 10 years?
Yeah, I think commodities as a group are obviously massive underperformers versus equities. Yes, that chart of the S&P versus commodities is a real outlier. But in amongst the commodities, I think you're going to see an awful lot of them struggle with, certainly in the initial phase of this. So if we start to get some real dollar weakness, which we might well do if this setup continues, then you could see commodities outperform. But energy within that commodity sector, I think given what's happening in the Middle East, given the kind of depletion of the US Strategic Petroleum Reserve, given the ongoing stuff in Russia, and the accelerating costs of the kind of green transition, I think within the commodities complex, the energy complex looks really, really appealing to me.
So I was going to switch to a bit on the stock market in general. And one of the slides I wanted to look at was from 1966 to 1982. And I could have put up 2000 to 2012. I mean, it would have been a similar look. But what do you think about the people that are in the industry today that have never seen that flat line, for a long time? And then that talking about adjusting, I don't think they've made any adjustments. If something like this happens, they very hard for them to adjust to it. What do you think?
Yeah, look, I think that's exactly right. But not only market participants, but investors too. Investors during this time that you've shown up here, famously the market went sideways for 15, 16 years. But there wasn't so much money put into index funds and ETFs and all these instruments that have been created to make life easier, and investors have herded into. So the investors are used to getting their 401k statements at the end of the year and seeing healthy gains. And yes, they've had a few nasty years, but it's been reinforced over and over again that you buy the dip, and if the market corrects, you don't worry about it. And over those last sort of 15 years, the market has gone considerably higher. And so they're not prepared for this. And at the end of the day, with inflation where it is, if people are starting to get their 401k statements at the end of the year and they don't have any capital gains to offset the inflationary setbacks they're going to have faced in their cost of living, it's going to refocus minds very, very quickly. And that's the piece of this puzzle that kind of we keep coming back to, is that it's very different, and people are going to have to deal with situations that they haven't faced and take actions that they didn't think they were going to have to take.
Well, and speaking of sort of different actions, by the way, your interview with Neil Howe, and I've interviewed Neil myself a couple of times, but yours is the best. That's the best interview I've ever seen with Neil Howe. I can't remember, it's an hour and a half or whatever it was, but you went through 4 sections. I would encourage anybody to look at that. And he talks about these changes. You get into a lot of different things with him, but maybe that's all part of it. What do you think?
For sure. Look, I think Neil and Bill Strauss's work on cycles and the fourth turning is absolutely required reading. I think if you read that, it gives you a really broad understanding of the cycles of history, and it gives you a sense of where we are now. Now, there are people that don't buy into that. I do, absolutely. I think cycles are just such an important part of humanity and markets. And I think when you look at Neil's work, and his work suggests that we are in a fourth turning that began in '08 and ends probably sometime around 2030. If you look at that and you look at past fourth turnings and you realize what they are characterized by, which is, financial crises, loss of faith in institutions, and ultimately conflict of various kinds, look, it paints a grim picture. It really does. But I think being a rose-colored glasses optimist and believing that, well, we can't think about the possible negatives, you've got to remain positive, it's worked remarkably well. And it works through the cycles when there is stability. It works through the kind of first, second, third turnings really, really well. But you only need to get called out once at the end. If you're not paying attention to the cycles, you can undo an awful lot of work that's been done over the previous cycles. And that's my worry, is that we're going to see a fourth turning play out. We're going to see conflict. We're going to see more financial crises, and people are still running the playbook from the third turning and the second turning, and they run into some serious problems. Now, the beauty of the fourth turning is it clears the decks for some real growth and some real positive changes to society, to markets, and that's what we have to focus on. But getting from here to there is going to be very, very difficult, and it's a case of look, you've made money in markets for 20 years. As long as you've been, even if you've just gone with the crowd, you haven't needed to be an investment genius to make money. But now that's going to be a really dangerous thing to do. You have to start thinking. You have to start taking actions that might seem, a little kind of, I don't know, knee-jerk. People are constantly talking about, people are doom mongers and doomsayers and all this kind of stuff. But there is a point in every cycle where if you don't have that mindset, you will give back an awful lot of your gains. And that's the cardinal sin, as you well know, of investing, is you just cannot afford to have big capital losses.
It's interesting you say that, because I think people fail to remember, and I remember because it affected us, that the number one catalyst for their returns over the last 30 to 40 years has been declining interest rates, even in the stock market.
That's exactly right. And people confuse it for their own investing acumen. It's just simply not true. If you have a consistently lower cost of capital, it masks an awful lot of sins, and does make, as we've seen, assets float higher. So, people need to be realistic about what the driving force is. And I think you're absolutely right about that being the main one.
Well, and I know, you've lived and traded other markets besides the U.S., and you're in the world as far as investment management. And it's interesting because the question I'm going to ask you has to do with where we are right now. But if you look at '89 in Japan, and to a degree '87, I was there at that, and then certainly '99, 2000 in the U.S., and then now. And this slide you're going to see, I call down memory lane. And the reason I put it up there is because I get, and I'm sure you hear this too, so many people talking about the big 7 or 8, that nothing can ever go wrong with those 7 or 8. But so I put up a 4 here that I was told nothing could ever go wrong on, okay? And all of them, lost 80% or so. I mean, and so what do you think about the concept right now that's floating around that, hey, everything's okay?
Well, look, you and I have been around long enough to know that that's just not the case. It's never the case. But at the same time, I totally understand why people think that, because things seem bulletproof. Peter Atwater, who I was talking to this morning, published a great book called The Confidence Map, which I would recommend anybody who's investing should take a look at. And it talks about exactly this: what happens at periods of extreme confidence, and that's what these charts depict. The confidence that nothing go wrong, the confidence that the Magnificent Seven are going to continue to go up. But if you look at take a look at the chart of ARK, for example, the Cathie Wood vehicle, the ARKK. If you look at that, it looks very much like that Time Warner chart. We saw this massive surge, and it's almost identical. And that is a very familiar chart pattern. And so we're seeing away from those Magnificent Seven, we are seeing these charts happen more and more. We are seeing these, all the meme stocks, GameStop, AMC, all those stocks have very similar charts to this. They've had their crazy moment in the sun, and all the interest has gone out, and they're back to where they were before. So it's happening, and it's happening on a more broad basis than you would think. It just so happens, back in the 70s, 80s, we had the Nifty 50. So you had 50 stocks that you could point to saying, hey, look how great these stocks are. They're all going to be around forever. Things like Kodak and Polaroid, which are no longer around, as we all know, we're going to be around forever. Now it's just 7. So all the focus is on these 7 stocks, and away from them, you can find plenty of charts that look very similar to this. And that's a much better indication of the broad health of the market and the kind of things people should worry about once the Magnificent Seven kind of exhaust attention and people are losing money elsewhere and need liquidity and need to take profits in those stocks. I'm not saying something like Apple, for example, is going to look like Time Warner. What I'm saying is it could do. And that's the thing that people need to understand. It could. All these things could happen now. And so changing your mindset from this could never happen to this is, there is now, let's call it a 5% probability that could happen. It should change the way you allocate. It should change the way your portfolio is constructed. Because if you've got 90% of your portfolio in those big 7 stocks, and you've gone from a 0% chance of this chart occurring to a 5 to 10% chance of it occurring, that requires action, and that's the part people haven't got around to yet, I don't think.
Well, I know you were in the business in '89. I'm not sure where you were, but
in Japan too. Yeah, I was in Japan.
And were you? Okay, well, it's just interesting because we lost accounts in '89 because we wouldn't own Japan. And people, you walk in our office and they'd say, hey, what you got? And you talk and they say, well, but you don't own any Japan. I said, well, it's too expensive. Okay. And it's similar. Well, all of these sort of look alike, and what happened after that? It's because you were in Japan. It was a hot market.
It was the market. Everybody wanted to be in Japan, and it did some crazy things. And then, like everything else, what was it that triggered the end of that Japanese bubble? It was rising interest rates. The Bank of Japan raised rates, caught a few people off guard. They had twin equity market and real estate bubbles. The rising cost of capital, it was all it took. And, we didn't see like a 1987 type crash in Japan, but the bloom was off the rose. The market fell for the best part of 2 decades. And it's only just now getting back to its 1989 highs in various places. Ironically, Japan's one of the markets that actually looks pretty decent in terms of places people can go. And I think this is one of the peculiarities of the US is that it's such a broad, deep, liquid market. A lot of investors are either frightened to go overseas or don't feel the need to. And they really, if you want to buy robotics companies, you want to buy entertainment companies, food companies, materials, whatever you want to buy, you can find companies in the US to kind of invest money into. But if you want to buy the best robotics companies, then you sometimes are going to have to go abroad. And I think that's the piece of the puzzle that, while it may not happen on a retail level just yet, it's certainly starting to happen on an institutional level, and that will suck capital out of the US and into places like Japan. Yeah,
and it's it's usually late in the game they figure it out, at some point in time, and then bring it on. And I had a couple of things I want to mention, but one of the things I wanted to ask you, I put this together, this last slide, food for thought. I'm not trying to predict anything here, I just wanted to show how much this year looked like 87. Now, unfortunately, I couldn't get the 30-year rate. I couldn't get the rate going back, 20-year rate going back to beyond May of 87 off my Bloomberg. But you'll see in 87 how the bond price was going down with the rates going up and the stock market was going up, similar to this year. Bond prices going down, rates going up, market made its highs in, mid second, third week of July. And those are similar looks in some ways. I'm not saying it's going to crash. I'm just saying when you get to a certain point, I think I'm asking a question here where people say, you know what, I think I'll take that return on that bond, and I'm not going to have as much in stock. Do you see it that way?
Yeah, and look, I mean, you can stick money in cash now for 3 months and get all kinds of crazy, close to 5% basically. So I think there's a real alternative now, and so as the kind of risk elevates around the world, whether it's in a market, that we've seen that inflation volatility rising, we've seen volatility increasing in the bond market, we've seen geopolitical volatility increasing dramatically. We're seeing an elevated level of volatility right across the investment spectrum. And so being able to put money to work in a bank account where it's perfectly safe and earn you a decent return, yes, it may not be keeping up with inflation for some people, but if you can get paid to wait, we haven't had conditions where you've been paid to wait since before '08. And I think that 87 was a little bit of an outlier, but I think what you're seeing on that chart on the right illustrates that perfectly. You saw bond markets falling. We saw interest rates going up. We saw equities climbing. But eventually that gravity hits and you see what happens in the equity markets. And I've lost count the number of people I've spoken to who are moving money into 3 month, 6 month, 1 year treasuries or money market funds or anywhere where they can get 5% is a big psychological barrier for people. If they can get 5% for no risk, there are an awful lot of people who would love to have had that option for the last 10 years, but haven't had it. And they've been kind of forced into areas of the market where they didn't really want to be, but they needed to make some kind of return. And so all those skittish investors are moving money to the sidelines as fast as they can. And ultimately that will have an effect. Again, the amount of target date money that's coming in and a lot of the money that's going into these index tracker funds is kind of set and forget. So there's going to be this passive bid underlying, which Mike Green has done some phenomenal work on. But still at the margin, there is an awful lot of money being shifted away from risk assets and into risk-less assets. And that has to ultimately have an effect.
It's interesting. You mentioned Mike. We'll be talking to Mike in December, and he does have some interesting points about how particularly the 401k and the pension business has just been loaded and locked in one direction. Just do one thing. They don't even think about anything else. All the retirement level funds and all that sort of thing. And one thing I was going to ask you, we see at least a lot of this. Maybe it's changing a bit. That's a question for you, but it seems as though the idea behind preservation of capital right now in the money management business is sort of on the back burner. It's not on the front burner. Do you feel like it's that way, or are we not seeing it right?
No, I don't think it's. I think that we're in the middle of that shift in perception. I think it's happening. I think people are starting to realize that I need to be more cautious now. I still think it's going to take a lot to upend that passive bid, but that passive bid has really been a tailwind to an awful lot of money going into these markets anyway. When it meets the headwind of people wanting to redeem, it's obviously not going to have as big an effect as it has had. And that kind of fulfills its own prophecy, because the less the markets climb, the more people get nervous and the more people think, well, maybe I'll shift my allocations away from equities and maybe I'll put more money into bond funds or commodity funds or, whatever it may be. So I think, and Mike will be much better for your viewers than I will at talking about this, because it really is his wheelhouse and he's done some extraordinary work in this. It feels to me like we're at that kind of rubber meets the road point in time where the one-way flow into these funds is just starting to waver and it's just starting to turn. And whilst it may only be at the margin so far, I think it's happening. And so we've yet to see how this plays out, because of course this phenomenon has grown during this period of declining rates. So we don't really know how it functions and the damage it can do when it's moving in the other direction. I hope we don't find out, but I suspect we will.
Well, Grant, we've always felt like we weren't so much market timers, but we really do feel like we're value timers in terms of what we look at. And I'm curious on this question for you. A number of people, over the past 12 months, they've sold a company or something, mostly along that line. They've got a lot of money. And we really espoused, hey, this is a fairly precarious time. You need to really think about icing a lot of that money for the time being. You'll always have a chance. It's not the last train out of the station.
Right.
What would you say to somebody like that? I just sold a company. I've got $25 million net. Would you have them hold off a while or really kind of settle down a bit?
Yeah, look, I think if someone's just sold a business, then the last 3 years have given them a very good up close and personal look at what volatility looks like. They've seen in their business, they've seen what the pandemic's done, they've seen what the recovery's done, they've seen how things can move about dramatically, and they won't have seen that, many of them, throughout the time they've owned that business. And so I think people are more inclined and predisposed to be more risk averse. Even people who've been entrepreneurs and have set up business and built businesses and sold them, they've had a really good window into how difficult it is for businesses to make money. And ultimately, if we're investing in equities in particular, you're investing in the businesses of those companies. People have gotten away from that, and people have kind of thought of stocks as something you buy to sell at a higher price later on, as opposed to ways to participate in the cash flows of really good businesses. And so that's going to come back, I think, again. People are going to want to invest in businesses rather than trade in stocks. And it's a very different mindset. So I think the advice you're giving people is absolutely spot on. If you had that kind of money, you're fortunate enough to make that money over the last 15 years, you'd be crazy to give it up and give it back now. And the reality is, whichever way you want to cut it, the environment right now is going to be the hardest environment to keep that money that you've had to face for some considerable number of years. So why take that risk?
So my last question to you would be, if you're talking to the age group of, say, 25 to 40, what would you tell them right now? Because they haven't gone through anything particularly bad in a long time in their investing careers. What advice would you give them at this stage of where we are?
Well, of course, the 20-somethings are really just kind of setting out on this journey. And what a time to be setting out on it. The things that happen to the 20-somethings in the next 10 years, they probably don't realize this yet, but it is going to define their entire attitude to risk for the rest of their lives. And so, if you think back of the generation that went through the Depression, they refused to take on any debt. There just wasn't any way they were going to take on debt. And grandparents of our generation lived their entire lives like that. They wouldn't have a credit card. They wouldn't, they would pay their mortgage off as soon as they possibly could. They would save everything they could. The generation, if you're in your 40s, you've gone through the last 15, 20 years of your kind of the kind of meat of your career, being encouraged to take on an awful lot of debt. And debt's good, and debt markets only go up and interest rates only go down. So you've had that behavior reinforced. So I think the 40-somethings are in for a sea change in what works, and they're going to have to unlearn some habits really, really quickly. The 20-somethings, I suspect, are going to need to learn some really good habits really quickly. And I think, frankly, if for kids of mine, I'd much rather my kids were 20 now, because I think the lessons they're going to learn in the next 10 years are going to be really, really helpful for them for the rest of their lives. I would worry, my eldest daughter's 32. I wouldn't want 40-year-old kids right now, because I think they've had some very bad lessons kind of hammered into them and reinforced over the last 20 years that if they can't unlearn quickly, they're going to unfortunately unlearn painfully. And I really wouldn't wish that on anybody.
Well, I'd be curious about that. I wrote a little book, one of the little books I've written is titled Your Money Mentality. And one of the things I write in there is you are biased about two things. One, whether you grew up with money or did not, number one. Yep. And number two, what was the time frame? Were you in a time frame when stocks and bonds did really well? Or like my grandparents, when they would never own anything? Or, don't you think that really impacts somebody the rest of their life?
Absolutely. And it's really tough to shift stuff like that. It
is.
There was no way you could convince anyone that went through the Great Depression to take on debt. You just couldn't do it. They'd seen what happened. And it's the same thing here in reverse. It's going to be very difficult to convince people that borrowing more money to get out of a problem isn't the solution. But with rates where they are, I think already there are people who have over leveraged themselves in real estate, particularly, who are learning lessons, the kind of lessons that hopefully they've got enough time in their lives and their careers to recover from. But some of them won't be able to. Some of them are going to lose everything because when rates go up, if you're over levered, it's the worst thing in the world. So if people have the presence of mind to read about history, to read about the hyperinflation's a perfect example. When Money Dies and The Dying of Money, two terrific books. And I think they're both available online in PDF form, free. But whilst I'm not saying we're going to get hyperinflation in the US, the chance is not zero anymore that we could have that. But just an understanding of what happens to money, what happens to society, what happens to assets and real estate and stocks and bonds in periods like that will be incredibly useful to people who haven't seen it and who have grown up in this time of kind of easy money and declining rates.
Well, listen, Grant, I know we're going to have a lot of changes in the next 10 years. I want to thank you for being with us. Also, everyone has been able to see Grant's website. I would encourage you to take a look at everything Grant does. I will tell you, Grant, I don't know how you find the time. I really don't. I mean, between your writing and your interviewing and your podcast, you do a lot. You cover a lot of territory, and it's all good. And I want to thank you for being with us today. We hope to see you again maybe next year.
Well, Ted, that's very kind of you. Thank you. And it's always a pleasure to get a chance to chat with you. So anytime, my friend, anytime.
All right. Thanks. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.